Hello, I'm Krista McAllister, and welcome to Cerius Leadership. Whether you are growing your business, growing your career, or possibly both, thank you for listening. Today the only way I can say it is esteemed guest, Jeannette Hobson. And Jeannette, you facilitate CEO peer groups. You're an incredible mentor and business coach. I'm excited to get into our discussion today, and thank you for spending time. I always enjoy speaking with you.
Well, thank you, Kristen. I enjoy speaking with you too. It's a pleasure, and thank you for inviting me.
And I'm surprised it's taken this long because we've known each other probably for the better part of a decade. And every image I have of you in my head is supporting CEOs to grow their business. That has been your life's work. And I'm curious, we've been through any number of economic and business continuity challenges over the past who knows how many decades. And as you've been doing this, I'm curious if you've seen any patterns as to some of the biggest struggles, regardless of what's happening in the macro environment. What are some of the biggest struggles that you see owners having when they're looking to grow?
That's a great lead-in question because, especially when you framed it in terms of all the different things that have happened over the last X number of decades that both you and I have been in business, it reminds me of a situation at about 2013. And if you go back and you think about what was going on in the economy in 2013, we were coming out of a very, very serious recession. People weren't sure. They were still in their foxholes. And I was speaking with one of my CEO groups, and somewhere in the conversation, I just made the comment, cash is king. And I remember one of the members who was a very successful entrepreneur, he actually stood up and he said, "That is the most ridiculous thing I've heard you say. Of course, we know that. Why are you saying that?" I didn't argue. I let it go. About 4 years later, he's now ready to exit his business. He was turning it over to his son. When asked the question, "What's one of the most important things you've learned over time?" he stood up and said, "Cash. If I hadn't had enough cash, I wouldn't have gotten through all of this." And I just kept my mouth shut.
Do not say I told you so.
Yeah, I just kept my mouth shut and smiled and said, "Yes, that's right. That is the biggest question."
We understand what prompted him. What prompted you from your experiences to be able to say to a group of CEOs who have grown incredibly successful businesses to get down to, no, you don't need to know anything else other than cash is king?
When times are good and business is good, people forget that without a supply of cash, without liquidity, whether it's their cash or somebody else's cash, they can't grow their business, because when times are good, they're making enough profit, they're generating enough cash, it's not a problem. But when times are bad, and we never know when that's going to happen, if they don't have enough cash, they either come to a screeching halt, have to start laying off people, or, God forbid, go out of business. People forget from one cycle to the next how important it is to get into the habit, the discipline of always having X number of months of operating expenses available in cash, no matter what's going on, to just have that discipline. And what I was trying to bring up, and in fact did instill with the peer group at that time back in 2013, was, now that things are getting better, now that business is starting to pick up again, we're going to get in the discipline. Every single month, you're going to report how close you are to your goal of X number of months of operating cash. And you figure out what that X number is. Is it 3 months, 4 months, 6 months? Whatever you say it is, every month, we're going to report on whether you're on that goal. And we did that for years.
Whether it's a working capital, operating cash, I've heard a number of different metrics on that. And I want to dig into that a little more because I've seen a number of companies, even in the past year or two, who didn't have their eye on that because they were looking at the P&L. P&L is, for the most part, pretty self-explanatory, but we'll get into that because I know that you do a lot of speaking on reading financials. And the balance sheet is just, it's like Star Trek for me. It's this whole other world, and we get caught up in the accrual basis of P&L and we think we're making money, we're doing well. What's the flip side of that? What really does that number of months of operating cash tell you?
It tells me a number of things. One of the things it tells me is whether that thing at the bottom of the P&L called net profit, how much of that is actually cash that I can spend? How much of that is actually in the bank? When people are fixated on the P&L only and they're driving to increase the top line, they think, well, sometimes they don't even think about the impact on the bottom line. But if they do think about the impact on the bottom line, they think about it as sufficient to fuel the growth that they're now embarked on, when in fact, net profit is nothing but a sum of the top line and all the subtractions that come from it in operating the business that period of time. It's not cash. But actually having X number of months of operating cash in the bank account is real cash. So if there's an emergency and all the banking systems shut down, you're not running around trying to figure out how you're going to pay your employees. Or, and you know, that might sound like it's never going to happen, but it has happened. It happened when the Trade Center was attacked. The banking system was shut down for a day or two. The people who had cash in the bank weren't panicked. They were panicked about other things going on, but they weren't panicked about running their business. When COVID hit, it was the same thing. We don't know if our customers are going to pay us or when they're going to pay us when there's a crisis.
That's probably one of the biggest reasons or tips that we talk about is everything else could be doing great in your business and the financial systems in place. But what about your customers? And if they start to draw out 45, 60, 75 days, one of the easiest ways is to look at that balance sheet. Someone once said the P&L, think of that as monopoly money. The balance sheet is where that monopoly money turns into actual cash and tells you your actual cash position.
When I'm speaking with CEOs, I play a little game with them. And the game goes like this. I say to them, look, there are three financial statements that are equally important: the P&L, the balance sheet, and the cash flow projection. They're equally important. But I'm going to play a game with you on the P&L because I want to make a point. And here's the game. I ask, how many of you collect your revenue through an invoice? And usually it's either 100% or 90% of the people in the room are actually collecting their revenue on an invoice. So I say to them, if you're sending an invoice, then when you write that number revenue with a $ in front of it on your P&L, you should take away the $ and you should put a please pay me or I hope you pay me, like a little heart. But you shouldn't put a $ because right off the bat, that top line is not cash. So if that top line is not cash, how can the bottom line be cash? Can't be mathematically. And they all just sort of go, oh yeah.
Anyone who owns a business recognizes what you're talking about. So you mentioned 3 reports. I want to dive into that a little bit. That P&L. What am I looking for on the P&L? What is that telling me as I'm making business decisions on a day-to-day or week-to-week?
The way I look at a P&L is it tells me if I'm pricing properly. The converse of that statement is, are my expenses too high? I like to think of it in the more positive way rather than are my expenses too high, although that is something you learn from the P&L. I'd rather look at it as, am I pricing properly? Because if I'm not pricing properly, then I'm not going to make enough profit from what I sell when I eventually collect. So it's those two things. It's, are my prices correct and are my expenses in line with the amount of profit that I really should be making?
As there's always that growth curve. You talked about it takes cash to be able to grow. My revenues go up, and usually the revenues are going up at one pace and your net profit is conversely going down on another pace until there's that tipping point. What is that process to go through? Is it doing an ROI analysis? Is it projecting? Is it just watching that gross profit, your gross margin versus your net profit percentage? What's the one thing I should be looking at to tell me, I'm expecting this. This is planned growth versus, ooh, something doesn't look right.
I love trend analysis. And I'm a big proponent of helping people see the value and looking beyond just quarter to quarter or year to year, but rather looking over longer periods of time. Because I make a decision. If I'm growing my business, I'm making decisions all the time on how I'm spending my cash. What assets am I going to spend my cash on to grow the business? I might be spending the money on people. I might be spending it on marketing. I might be spending it on equipment. It depends on the nature of the business, but I'm making those decisions all the time about how I'm going to spend my cash, invest my cash. And the only way that I know of that will tell me if my decision's paying off is if I do a trend analysis, because the money I spend in year one actually may not show up until year two or year three. And so I trend line all the major areas on the financial statements to see, are they in line? Is it growing consistently the way I expected? And you brought up a good point a minute ago, Kristen, when you said if the top line's growing at a healthy percentage, what's happening to the bottom line? You can't see that unless you turn everything into percentages. If you're only looking at dollars, you can't see that. It has to be percent. So my dollars of profit may be going up, but the percent may be going down. So I turn everything into percent.
My takeaway, do the trend analysis, be looking at the numbers. Am I pricing correctly? Am I maybe operationally structured to support that growth? And what's the change in percentages? Next, I've got the balance sheet in front of me. What am I looking at? Because this really, it just ends up being the, not necessarily confusing, but what is it really telling me? I see assets, I see liabilities. Some of us know the accounting equation. What's my takeaway and what am I looking for in order to run my business?
When I first started learning about these things, I was afraid of the balance sheet, mostly because I didn't understand what the words meant. But once I understood the language of the balance sheet, it is now my favorite thing. When I look at financials, I go to the balance sheet first before the P&L. It wasn't always that way, but that's the way it is now, because the balance sheet is telling me so many valuable things about the way the business is operating. So, of course, cash, we spent some time talking about that. The balance sheet tells me how quickly I'm collecting. It tells me how quickly I'm paying, because I can do a comparative analysis from one period to the next that will tell me how fast over the period of the year between the two balance sheets, how quickly have I been collecting over that year? How quickly have I been paying? If I'm collecting slower than I'm paying, that is a big clue to me that I'm probably going to have a cash problem. If inventory is staying on the shelves longer than I would like for it to be staying on the shelves, that's cash tied up, sitting on a shelf. I'm going to run into a cash problem sooner or later. But the other things I like to do with the balance sheet have to do with, let's call them how the business is operating. What kind of return are you getting on your assets? ROA. You're spending money on assets. What kind of return are you getting? Oftentimes people say to me, well, what's a good number? And my answer always is, when you do this over a period of several years, if the number's going up, if your return on assets is going up, that's a good thing. So wherever you started from, it should be getting better. If it's not getting better and it's staying the same, then you're investing your money in something that's not giving you, go put it in the bank. I mean, you could put it under the mattress and it would do the same thing. Return on investment. People look at the return that they're getting on equity. Most business owners don't think about that. They don't look at that, but they should. It's their equity. They should be looking at an increasing return on equity over time. What's interesting about the idea of return on assets is when you just do a classic definition from the balance sheet, payroll doesn't show up on the balance sheet. But if you're a service business, that's your main asset. So your main asset, if you're a service business, isn't on your balance sheet. And I'm talking about looking at the balance sheet to see what your operating performance is. So what do you do about that? How do you do that? What I advise people to do is to take their total payroll expense, total, whatever it is, including if you're paying recruiters, if you're doing training, whatever your benefits are, your total payroll expense, and pretend that that was on your balance sheet as your assets.
Mm-hmm.
And so year over year, you do a return on payroll as if it was a return on assets, as if it was on your balance sheet. And you compare that year over year and see if it's increasing. Because if you're spending a lot of money on payroll and you're not getting a better return, your productivity is not doing better, you're not getting anywhere. You're just standing still.
Any type of service business or job-based business, that's the first place I go to is, let me see your payroll. What is that number? Let me see the entry system where we're logging our billable time, our job time. What's the delta in between and what's causing that? With payroll being anywhere from 40 to 65% of most businesses, that ends up being one of the biggest telltales. And you're right, it's not sitting on the balance sheet.
It's not on the balance sheet.
In some cases, it's not even sitting on the P&L. It's in two completely separate systems.
Yeah, right.
We got to pull it. So we've got, and then you also mentioned on the balance sheet, your operating cash, working capital goes by a couple of different names. There was a third one that you mentioned, cash flow projection, which in most systems, especially small to mid-size businesses and their accounting systems, that's not a report that I can click run on. I can click the cash flow statement, but that's a moment in time, and I could have just paid payroll, the credit card statement, and it says one thing, but a week later it tells a very different story. It's a little fickle. It's good for long periods of times, not for short. The cash flow projection. Tell me more about that, because it's not a standard report.
It isn't a standard report, and it is, in my view, as important as the other two to have a really good handle on running your business. Cash flow projection. It's a pain in the neck to do it. There's no question about it. I don't want to do it. I don't like doing it. But there are some people who love to do cash flow projections, and they're the ones who should be doing it. But that's who does it is a different story. What is it? It is possible for every business, looking at what they did last year and what they plan to do this year, to make a fairly accurate projection by month of how much cash is going to come in and how much cash is going to go out. So it includes what the starting balance of cash was at the beginning of the month, any cash that you expect to collect from receivables. So if you know that your collection cycle is pretty accurately 35 days, if you know that and it works pretty well that it's 35 days, then you can predict, based on what you believe your sales will be month to month, what your cash collections will be every month based on a 35-day collection cycle. You know what your rent is, you know what your utilities are, you know what your payroll is, you know what you're accruing or actually paying for insurance or other things. So that's all cash out during the month. You know those things. They're pretty standard. You can come pretty close to forecasting at least for 36 or 39 weeks. I like 52 because you can change it. But some people really like to only go out 36 or 39 weeks, which is great. You can forecast that pretty well. And one of the reasons it's such a good idea is cash in, cash out is lumpy. Not every month is the same. Some months your expenses are really high. You have taxes to pay or insurance payments or who knows what that only comes in periodically. You don't want to be caught off guard. But if you project, this is the month when I have to pay that, will I have enough cash? Then you're never caught off guard with how much cash you have, so that two things happen. Number one, no surprises. And number two, if you do want to make an investment, some great opportunity comes along, you can look at your cash flow projection and see what impact spending that money is going to have. No surprises.
I love that. And that's probably one of the first things when CFOs get into a business is they're doing the trend analysis and they're doing a cash flow projection. And even if there's lots of cash to be had, they're doing that projection. And one of the strategies I've heard from individuals who work with small to mid-sized businesses is they try and tie some of that cash flow projection into the balance sheet with liabilities. So if there's a tax payment to be had, it might be on the cash flow statement. Let's accrue it in our liability so we know what's coming 6 months from now, 9 months, 12 months. And they try and give more visibility inside of the system and kind of put some liability buckets in there of, we've got this coming. We need to not be counting it as working cash.
Yeah. I've even seen people accrue year-end bonuses, accrue them over the year, so that when the year end comes, they've got the cash.
And even if the bonus isn't paid out, then great, it goes from the liability into the asset, but at least we're planning for it, because, sometimes we're busy running our companies. We did not get an MBA. We did not go through financial training. I need a number to be able to look at and know that's my number, not say, yes, but did you see this spreadsheet over here? It's not something I want to bother with. You've got those 3 reports, and we never know what's going to come. CEOs are sit and wait. Others are very opportunistic in taking advantage of whatever economic environment we're in. What would be some strategies that leaders can use to enhance their profitability based on insights? Because you can make money one of 2 ways. You can go sell stuff or you can save it. It's usually easier to save it than to go make it. What are some strategies that you recommend for business owners to kind of enhance that? Because if you're enhancing the profitability, in general, you're enhancing your cash position.
Generally, you are, yes. A couple stories come to mind if you're up for it.
Absolutely.
I remember sitting with one of my clients who was a manufacturer distributor. And he did not have a lot of financial background at all. He made the mistake that a lot of people in his situation make, which is, I'm paying a professional who has a credential. Whatever they tell me is correct. Because he didn't know how to look at the financial statements he was getting. Anyway, we were sitting over a period of a couple of months, and I kept looking at his inventory, and I would ask him questions about his inventory, and he couldn't really answer them. But it was the way the inventory was being tracked that I was questioning. Well, after a period of some time, and as I began to teach him more about the balance sheet and why this particular question was of interest to me, and it's because he was always tight on cash. His top line was growing, and he was always tight on cash. And that's the problem we were trying to solve, which goes along with your question. Anyway, to make a long story short, what we discovered was that the way his inventory was being reported, and therefore what we were looking at, was not correct. And because we weren't looking at it correctly, we couldn't make good decisions about the inventory. So we had information upon which we were making decisions that was faulty information. Therefore, we were making bad decisions about when to order more, when not to order more, what was a good amount of inventory to keep. And so he was constantly buying inventory, using up his cash as his business was growing, because he didn't have good information about the inventory he had on hand. When we got that fixed, he was able to have enough cash to get out of this constant concern about how he was going to meet payroll and to comfortably grow his business. So that sounds like a pretty simple fix, but for him, it was a real eye opener because he was relying on the information he was getting and didn't know enough to question how that information was getting there and how it would impact his decisions. It really was impacting his purchasing decisions. Another situation that comes to mind kind of has to do with margins, which goes back to the P&L. One of my clients is in the clothing business. He designs, manufactures, and distributes to all the big and smaller retailers. And people who are in that business know that many of the large retailers make it tough for the business owner to make a big margin. So as his business was growing, the bigger retailers were disproportionately a larger and larger percentage of his revenue. So he's seeing his top line go up, but he's seeing his margins erode. And so we sat down and we looked at what the margin was per customer, which he had a pretty good handle on, but we started with that. And then what we did was we said, let's take these one or two really large customers who are producing the lowest margin. Yes, they're giving you the highest revenue, but they're giving you the lowest margin. Let's pretend we're looking at contribution margin to talk about it in the way an accountant would say. Mm-hmm. I said, let's pretend you didn't have those accounts. Yes, your revenue would go down, but let's look at the impact it would have on your actual margin dollars to run the rest of your business. And let's look at how many extra people you've had to hire to service those accounts because they take a lot more hand-holding and they have a lot more problems. So how many more people have you hired to service those accounts? If we took those accounts out and we took those expenses out, what would it look like? So we went through that exercise and he saw that he was actually going to make more net. Wow. Because he was such a good business person, he was able to, within 2 years, he was able to fill that hole in revenue with much better business, with much better margins. And so at the end of the day, the whole business was better.
It's amazing. We have to talk about numbers tell a story. Yeah. Stories don't always come in words.
Right.
They come in numbers. And being able to look at your business by the numbers, by customer, by geography, and by product or service line. You hit the nail on the head. Probably some of the quickest ways that you can find better or improve profitability in a business is, are we selling some lost leaders? Is one geography costing us more than another? Or the customer, sometimes we're actually paying to have that logo.
Yeah.
As our customer, and we don't necessarily, because you get so caught up in the day-to-day of running the business.
And we get caught up with the top line, how important it is to grow the top line.
And sometimes that's at a cost of everything else. Now, Jeannette, I know you do a lot of speaking, you work with coach CEOs, and you help facilitate and you speak to CEO groups. I can't imagine how many business owners or CEOs that you have come across over the last few decades. I know as part of Vistage International, one of the larger peer groups, with all the speaking that you do, and there's probably hundreds, if not thousands, that you've come across, I'm curious as to what's maybe one or two of the top questions that you get when you start speaking on understanding the financials, what should you be looking at? What, without failing, almost every time you're presenting, what's one of the questions that you get? I don't think I've ever stumped Jeannette Hobson. Ever.
I think if I were to, the question may be asked in different ways, But what it all comes down to is why should I take the time to look at these financial statements? I know my business. I have KPIs that help me drive the business. I look at those KPIs. I understand what's going on. Why should I be taking the time to understand this?
And what's your answer?
My answer to them is that number one, other people care about your financial statements. So if you need to get money from other people, they're going to look at your financial statements, and those financial statements need to be correct. Otherwise, you're not going to get very far in the conversation. And secondly, the financial statements will tell you things that the KPIs won't tell you. And it's what they tell is a different story depending upon the nature of the business. And depending on who's asking the question, I'll come up with the specifics for them. But the reality is, those financial statements, especially the balance sheet, will tell the business owner operator things different from what the KPIs are telling them.
Which is a struggle, because we always tell businesses, your financials are your lagging KPIs, those lagging indicators. What you see in your business on a day-to-day between marketing, accounting, engineering, operations, how much you're shipping each day, those are your leading indicators to say, am I running the business on a day-to-day correctly? Do I need to make course corrections versus waiting until the numbers come out and tell me? But those two together, are we measuring the correct KPI? Is our baseline, is our goal KPI correct? Like, the financials then tell you whether you got it right or not, or whether we're measuring the wrong thing.
Did your decisions actually pay off the way you thought they would? Because you're making all these decisions all the time, but until you actually look at what happened, to your point, the financial statements are what happened. Until you look at what happened, you don't know if your decisions were the right decisions, or not the right decisions, whether they paid off the way you thought they would.
Everything is an investment. And then we bring it full circle. You've got your KPIs are your leading, your financials are your lagging. And with really good financial support and analysis, you can create a crystal ball. Now I know what's predictable, and I know what my business will look like 3 months, 6 months. Now I can get ahead of it.
Right. I feel better about the decisions. Right.
Yep.
I'm prepared.
You mentioned a lot, Jeannette, about decision making. And as owners, we often think we've got to make all those decisions, when in fact, our leadership team and individuals who are really in the business on a day-to-day are the ones needing to make those decisions. What advice do you give when you get the question, what do I share? I've got access to everything. All right, I know how to read these financials. I don't want to share that. I don't want anyone to know what I'm making. What information should be given, regardless of anyone's hesitation to share? What information or what guiding principle should we use when sharing the answer key? Here's what the financials are telling us.
So can I answer that question second? And can I answer the question of, should I share first? Because I think that's actually the bigger, I think that's actually the harder one to crack, is, should I share this? Why should I share this? And I promise I will get to your second question. I love live theater, not because I'm starstruck, but because to me, live theater is a metaphor for what goes on in running a business, in running a team. And here's where I'm going with this. The director watches people come and go as they audition for parts in the play, and the director figures out which actor is going to fit which role. These are all highly skilled professionals, but the director sees something in the audition that makes him or her believe that this particular actor would be better suited for this role. Okay, so we go through that process. Once the actors have been given their roles, they have an opportunity to understand the entire story, the entire play, but then they practice their part alone. They learn their part in the context of the whole story.
Mhm.
But that's not the end of it. What happens is then they all come together and they practice all together how this is going to work in the story. Because if they don't all come together and practice what's going to happen in the whole story, if each actor is just individually learning their lines at home and then they show up on opening night, never having practiced together, it's not going to work. And likewise, if they only get the script for their role and they haven't seen that role in the context of the whole story, they have no idea how they're supposed to act because it's just a script. Okay, these are your lines.
Mhm.
Memorize these lines. Here's when you say them. But that's not the way it's done, right? It's all done in the context of everybody and their role in the context of the whole story. I use that as a metaphor for why CEOs should have their executive team understand the financials, because the financials are like the story. Their job, their role in the company is the actor. They
Mhm.
have their script. They know what their script is, what they're supposed to do in the company. But they come together with these other people to make it all work. But if they don't have the context of the whole story, which is the financials, because that's what tells what's going on, how can they possibly know what would be more effective for them to do? They can't. So to me, the executive team has to know something about the financial performance of the company in order to be able to execute their role, make suggestions, make improvements, because they see it in the whole context. They see what the result is of what they've been doing. That's my little story about why this is important. What
I,
should they be told?
yes.
Um, if the CEO doesn't want to give exact numbers, you can give percentages. You can give high level categorized percentages. You know, I don't think any CEO is bashful about saying what revenue is. They usually are pretty good about that. But it would be even more impactful if they talked about percent increase in revenue. Okay, here's where we started. Here's the percent increase. Here's what our fixed expenses. Teach people what are fixed expenses. What does that mean? What are variable expenses? What does that mean? What's the sum total of our variable expenses as a percentage of our revenue? Is it going up or down? The variable expenses, most of the time, most of the people on the executive team can't control, but a few people can.
Mhm.
Most of the people on the executive team are operating within the things that they control, which are the operating expenses or the revenue if they're in sales, right? So let people see how the things that they have an impact on are increasing or decreasing percentage wise so that they can see what their efforts are producing and how their efforts fit into the whole thing. If I see the whole story, then I understand. If you tell me I have to reduce my payroll, that's painful. But if I don't see how that fits in to what the company's whole performance is, I'm going to do it because you tell me, but it's really painful to me personally to do that.
And you may end up, you now need to overcompensate for that in other ways, which may be to even more the detriment. I've never heard it put in the realm of theater and acting. So whether it's acting or sports teams, there's this thing called blocking on the stage where you go to this mark and someone else goes to this mark, so the two of you aren't standing on top of each other or hitting each other off the stage. Same thing in sports scenarios. And you can see, just using your example on the by customer analysis, your marketing team might be ready to launch a whole campaign on a product that is a loss leader, while your sales team is looking to hire an account manager for that customer that's costing you money to service. and they have no visibility and no idea to that end, and they might be able to spot some of those patterns and know what's going on even more so than maybe top leadership or ownership can.
They could
So
be more helpful. Yeah.
yeah, sometimes it's giving them that analysis and the segmentation data so that they can make those right decisions. We hear it a lot in construction companies. Project managers don't know how much is being made. They aren't given the how much the job is costing, how much we need to make, and what we're making on it at all or after the fact. And they're the ones controlling all the decisions.
Yeah, for sure.
So tying it to the decisions on that. You've mentioned a lot on planning and looking ahead. I think that's one of the areas that I see a lot of owners, we struggle a lot, is that budget. Does
Mm.
every company need to do a budget every year? That's strategic planning is separate, but sitting down and doing a budget. I know what I'm spending. It's cash out, cash out. I got this, Jeanette. What do I really need a budget?
Well, it's not only I got this, it's I don't want to have my hands tied from taking an opportunity that comes along that I didn't budget for, right? Because entrepreneurs are very opportunistic. Don't tie my hands about taking advantage of an opportunity, and they see the budget as a constraint. So my job in convincing people why they need a budget is to help them see that it's not a constraint. It's a discipline. It's not a constraint. And I work very hard to help people see, again, why they should do it and then what's going to happen when they do it. And I joke about it a lot. You know, we need to laugh about this stuff. I say to people, I'm going to convince you that you need to do a budget. And at the same time, I'm going to tell you that the first 3 years that you do a budget, you're not going to be happy with the result. So just get over it. It's going to take you 3 years to get it right, and that's okay. And I've actually had people who have been clients of mine for a long time come back to me later when they heard me say that to a person who's just starting to work with me, and they laugh and they go, yep, it's exactly what happened. It took 3 years to get it right. But the real question is, why should I go through that? Right? That's the real question. If it's that hard and it's not going to be right the first time, why should I do it? It's a discipline that helps you know when you can go off the reservation in a decision you want to make and when you shouldn't. Because if you're the business owner, you want to go off the reservation once in a while. The question is, what's the implication of going off the reservation? If you have a budget, you can see what that implication is going to be. And then you can decide decisions again, right? The whole thing here is decisions. Everything we do is decisions. You can decide whether this thing that you didn't plan for, which is such a good opportunity, is worth doing. But then you can look at other things that you did plan for that you may not see as the same level of opportunity and say, I won't do that. I'll do this. But now you're actually making a decision, a choice, because you're looking at two things that have roughly equal cost involved and will not cause the business to suffer in any way, because the dollars are fungible. Whether I put them in A or put them in B, it's the same dollars, but I planned to spend them. I'm just changing what I planned to spend it on, because I see that B that I didn't plan for is a better opportunity than A that I did plan for. Okay.
And whether we're having that discussion in our heads, saying I'm intentionally doing this and here's why I'm doing it, our leadership team, or the individuals that it's impacting, saying rather than doing this, I'm going to do this and here's why. One, you get some feedback, or two, then the discussion stops there and you're not dealing with the inside conversations over the next 6 months of why was that decision made. There's
Right.
you just cut all of that out. It increases productivity. I want to get to some top level pieces of advice because Jen, you have shared so much on financials, and not from a CPA or CFO perspective, because that isn't your background. It's from a few decades of working with business owners, helping them grow their company, helping them get out of struggling cash flow positions in order to then grow the business that they want for them, for their families, for their employees. From that perspective, what some key pieces of advice that you would give business owners or CEOs in regards to their financials, understanding them, creating them, analyzing them, going into next year, and whether we're in the middle of the year or the end of the year, it doesn't matter. Looking ahead, what pieces of advice would you give?
Begin with the end in mind. Have a clear picture of where you're going. And you may not have such a clear picture of how you're going to get there. That's okay. But if you have a clear picture of where you're going, then it means that the major decisions that you make with your business are being done with the intention of reaching that end goal in mind. And it's not just 1 year. It's a longer period of time. The decisions you make next year should help propel you closer to that end goal that you want, however many years down the road it is. If we begin with the end in mind and we have a clear picture of what that looks like, then we start to fill in backwards. Well, what does that mean in terms of the performance of the business? And what does that mean in terms of how I'm going to finance that performance of the business? And where's that money going to come from? And if I know that the money is going to come from an outsider, then what do I have to show the outsider to be a good candidate to get good terms, right? Because I want good terms. And if the money is going to come from me personally, then am I financially able to take that risk? If I'm financially able to take that risk, then what's my plan to pay myself back? So all of those things go into the kinds of questions I ask people when we start thinking about next year. Well, what should I be thinking about for next year? To me, those are the questions I would ask.
It's not just next year, it's 5 years, 10 years, because that then almost decides for us what is next year going to look like.
Yeah, exactly.
Stepping blocks. Jeannette, thank you so much for your authenticity, your openness, and you are not only one of the most intentional leaders I know, you help guide others to be more intentional about their business. And I love that you ended with begin with the end in mind, because that is always that place that you're starting, and those questions that you ask and you say, well, what are we actually looking to accomplish with this? And I can hear you in my head asking that question.
Yeah.
I love it, Jeannette. Thank you for joining me. And until next time, because there's always a next time, take care.
Thanks very much. This has been a great opportunity to learn from you as well. I love the way you integrated the conversation. So thanks for that.
Take care.
Okay. Bye-bye.